Hey there, investors. Ever wonder what happens when the king of the hill gets knocked down a peg, or 50? Today, we're diving deep into Nike, the company that convinced us all that we could just do it, even when it was sitting on the couch eating chips. But here's the kicker. While you were buying those Air Jordans for $200, Nike's stock took a nosedive that would make even the most extreme skateboarder nervous. Down 61.78% from its all-time high. Ouch. So is this the buying opportunity of a lifetime, or should you run faster than Usain Bolt in those fancy spikes? Stick around, because the numbers we've uncovered might just shock you. Let's rewind to 1964, when bell-bottoms were cool and a guy named Phil Knight had a wild idea. Knight, a middle-distance runner at the University of Oregon, teamed up with his track coach, Bill Bowerman, and started a little company called Blue Ribbon Sports. Their mission? Import high-quality, low-cost Japanese running shoes and sell them at track meets across America. Fun fact, Knight literally sold shoes out of his car trunk. Talk about humble beginnings. By 1968, they rebranded as Nike, named after the Greek goddess of victory. And boy, did they live up to that name. Bowerman's breakthrough moment came in 1972 when he literally poured rubber into his wife's waffle iron to create the iconic waffle sole. Innovation? More like breakfast-inspired genius. Fast forward through decades of "Just Do It" campaigns, Michael Jordan's gravity-defying dunks, and enough celebrity endorsements to fill a stadium, Nike became the undisputed king of sportswear. The swoosh became more recognizable than most country flags. Here's where it gets interesting. Phil Knight, now 87 years old and worth around $34 billion, stepped down as CEO back in 2004 and as chairman in 2016. He's now chairman emeritus, basically the wise sage watching over his empire. The current CEO is Elliott Hill, who took the reins in October 2024 after previous CEO John Donahoe's, let's call it, turbulent tenure. Hill is a Nike veteran with 32 years at the company before retiring in 2020. He came back like a sports movie protagonist to save the day with his win now, turnaround strategy. Since taking over, Hill has reshuffled the entire leadership team, promoting Amy Montagna to president, bringing in new chiefs for innovation, marketing, and growth. It's like watching a coach rebuild a championship team after a losing season. Current market position. As of mid-2025, Nike still holds the number one spot globally in sportswear with a market cap of $101.2 billion, though competitors like Adidas, $43.4 billion, Anta, $32.7 billion, and upstarts like Hoka and On Running are breathing down their neck. Let's talk numbers, folks. And spoiler alert, they're not pretty for 2025. Revenue journey, 2015-2025, 2015, $30.60 billion 2024, $51.36 billion 2025, $46.31 billion. For 9 years, Nike was on a rocket ship. They grew revenue at a 5.92% compound annual growth rate from 2015 to 2024. That's solid, steady growth, the kind investors love. But then 2025 happened. Revenue created by 9.8%. That's nearly $5 billion in sales that just evaporated. To put it in perspective, Nike lost more revenue in 1 year than some entire companies are worth. What happened? Well, Nike's aggressive direct-to-consumer (DTC) strategy backfired spectacularly. They alienated wholesale partners like Foot Locker and Dick's Sporting Goods, thinking they could go it alone. Turns out, burning bridges with retailers who've been selling your shoes for decades isn't the smartest play. Here's where it gets worse. Profit margins over time. Gross margin dropped from 44.56% 2024 to 42.73% 2025. Operating margin collapsed from 12.29% 2024 to 7.99% 2025. Net margin fell from 11.10% 2024 to 6.95% 2025. Net income plunged 43.5% from $5.70 billion 2024, to just $3.22 billion, 2025. That's nearly half their profit gone. Earnings per share, EPS, dropped from $3.76 to $2.17. If you are a shareholder, your slice of the profit pie just got a lot smaller. Why the margin massacre? Increased promotional activity, aka discounts to move stale inventory, higher operating costs, and inventory management disasters. They literally had shoes piling up in warehouses like a sneakerhead's dream, except it was a nightmare for profits. Surprisingly, this is where Nike isn't in terrible shape. Total debt, 2025, $11.02 billion. Total equity, $13.21 billion. Debt to equity ratio, 0.83. For comparison, Benjamin Graham, the godfather of value investing, preferred companies with DE ratios below 0.5. Nike's at 0.83, which isn't alarm bell territory, but it's not squeaky clean either. They have manageable debt, but it's higher than ideal. Operating and free cash flow tell you if a company can actually generate cash or if it's all smoke and mirrors. Operating cash flow dropped from $7.43 billion, 2024, to $3.70 billion, 2025, a 50% decline. Nike still generates positive cash flow, which is good. But losing half your cash generation in 1 year? That's like a runner suddenly running at half speed. You're still moving, but something's clearly wrong. The bottom line, Nike went from a well-oiled profit machine to a company scrambling to fix self-inflicted wounds. The 10-year story was great until 2025 turned into a cautionary tale. Alright, chart geeks, let's look at the pretty pictures, except they're not so pretty. Current price, October 15, 2025, $68.46. Historical performance, 10-year return, only plus 10.56%, from $61.92 in October 2015, 5-year return, a disastrous 46.37%, from $127.65 in October 2020, distance from all-time high, $179.10, down 61.78%. Let me repeat that. If you bought Nike stock at its peak, you've lost nearly 2/3 of your money. That's not a correction, that's a demolition. 52-week range and key levels: 52-week high, $84.76, 52-week low, $52.28. Current position, about 19% below the 52-week high and 31% above the 52-week low. Technical indicators, as of October 15, 2025. RSI, 14-day, around 11.90, 30.44, deep in oversold territory. For context, anything below 30 screams, heavily sold off. This could signal a bounce, or it could mean the selling isn't done. MACD, negative at around 1.49 to 5.76, showing bearish momentum. The stock is trending down hard. Support levels, $69.70, current trendline support, right where we are now, precarious, $52, the 52-week low. If that breaks, buckle up for more pain. Resistance levels, $73.76, first major resistance zone, $80.85, next ceiling if momentum shifts positive. Moving averages, the stock is trading below its 20-day, 50-day, and 200-day moving averages, a classic bearish setup. When you're underwater on all major moving averages, that's the market telling you, not yet, buddy. The verdict, technically, Nike is oversold and could bounce. But the downtrend remains intact. Any rally faces heavy resistance. Traders might see short-term opportunities, but long-term investors need more than chart patterns, they need fundamentals to turn around. What would the father of value investing say? Benjamin Graham, Warren Buffett's mentor, gave us tools to determine if a stock is truly cheap or just cheap for a reason. Let's run Nike through the Graham test. EPS, TTM, $1.95 book value per share, $8.94 Graham number, $19.80 current price, $68.46. Valuation gap, Nike is trading at 245% above the Graham number. In other words, by Graham's strict standards, Nike is massively overvalued. Graham would say you should only buy when the price is at or below the Graham number. At $68 versus $19.80, Nike would need to drop another 71% to hit Graham's buy zone. Yikes. Graham's quality criteria checklist. Current ratio, greater than 2.0 preferred, Nike's at 2.21 check mark, good. They can cover short-term debts, debt to equity, less than 0.5 preferred, Nike's at 0.83 cross mark, higher than ideal, positive earnings growth, negative growth in 2025 cross mark, earnings down 43.5%, PE ratio, less than 15 preferred, Nike's at 35.11 cross mark, more than double Graham's preference. Score, 1 out of 4. Graham would take one look at Nike and say, pass. But wait, context matters. Graham's rules were designed for ultra-conservative investors in the 1940s-70s. Modern growth companies rarely meet his strict criteria. That said, even adjusting for today's market, a PE of 35 with shrinking earnings is not great. Fair value estimate. If Nike can return to normalized earnings of $3.50 4.00 per share and deserves a PE of 2025, reasonable for a quality brand, fair value could be $70,100. At $68, you're maybe at the lower end of fair value, not a screaming bargain, but not insane either. 1. Brand power is still immense. Nike remains the strongest apparel brand globally, brand strength index, 94.7, 100. The swoosh isn't going away. They still have unmatched brand equity. 2. Elliott Hill's turnaround potential. Hill knows Nike inside and out. His win now strategy focuses on rebuilding wholesale partnerships, fixing product innovation, and refocusing on sports performance. Early signs from retailers like JD Sports are positive. 3. Oversold technically. RSI in the teens, down 62% from highs, classic contrarian setup. If sentiment shifts, there's huge upside potential. 4. Still generates billions in cash flow. Even in a bad year, Nike produced $3.27 billion in free cash flow. That's real money to fund dividends, buybacks, or reinvestment. 5. Market leader in a $400 billion plus industry. Global sportswear is growing. Nike's still number 1. They don't need to invent a new category, just execute better. 6. Dividend yield of 2.34%. Not huge, but it's there. You are getting paid to wait for the turnaround. 7. Valuation has reset. At APS ratio of 2.19, Nike is trading near multi-year lows. If they fix operations, re-rating upside is significant. Bear case. Reasons to be pessimistic. 1. Earnings collapse. Net income down 43.5% in 1 year. That's not a hiccup, that's structural damage. 2. Market share losses to competitors. Hoka, On Running, Adidas, New Balance, they're all eating Nike's lunch. Nike's losing the cool factor with Gen Z, and in fashion, that's death. 3. Failed DTC strategy. Nike burned bridges with key retail partners, then realized they needed them. Rebuilding trust takes years. 4. Ongoing controversies. Securities fraud lawsuit over misleading investors about the DTC strategy. Unpaid wages to overseas factory workers, $2.2 million owed since 2020. Labor violations in Cambodia, India, Thailand. Trademark theft lawsuit. Nike accused of stealing tech, then trying to bury the small company. These aren't just PR problems, they're brand damaging, expensive legal headaches. 5. Innovation has stalled. Nike's been leaning heavily on old franchises like Air Force Ones and Dunks. Meanwhile, competitors are innovating faster. 6. High valuation despite problems. PE of 35 with declining earnings? That's optimistic pricing for a company in crisis mode. 7. Tariffs and supply chain risks. Global manufacturing exposure means tariff headwinds and geopolitical risks. Major scandals: $2 billion securities fraud lawsuit, 2024-2025. Investors allege Nike misled them about the consumer direct acceleration strategy, hiding operational failures while promoting it publicly. The lawsuit claims Nike knew the DTC pivot was failing but kept spinning it positively, leading to billions in shareholder losses. Unpaid factory workers. Over 4,000 workers in Cambodia and Thailand are owed $2.2 million in legally required wages. Activist investors with $4 trillion in assets under management are demanding Nike pay up. Nike has largely ignored the issue for 4 years. Labor violations in India. More than 400,000 garment workers in Karnataka, India, received below minimum wages at factories in Nike's supply chain. Trademark theft allegations. A civil jury found Nike guilty of infringing on a small company's trademark and technology. Nike then allegedly tried to bury the company in legal fees. Bottom line, these aren't isolated incidents, they're a pattern. Nike's facing serious reputational and legal risks. Global market position. Where Nike stands: number 1 in global sportswear by market cap, $101 billion, and brand strength but losing ground fast. Adidas gaining 0.1 percentage point market share in 2025, Nike losing 0.3 points. Hoka and On Running growing at double-digit rates. Nike's falling from the top spot in youth, coolness, rankings. Regional performance. North America, $19.6 billion revenue, largest market, but declining. EMEA, Europe, Middle East, Africa, $12.3 billion. China, APEC, strong competition from local brands like Anta and Li-Ning. Nike's still the heavyweight champ, but younger, hungrier fighters are landing punches. The nuanced take. Nike is at a crossroads. This is a turnaround play, not a buy and forget blue chip anymore. If you believe Elliott Hill can fix the culture and strategy, wholesale partnerships can be rebuilt, product innovation can return, the brand remains strong enough to reclaim lost ground, then Nike could be a contrarian opportunity at $68. But if you are a conservative value investor, the numbers don't justify the price. EPK of 35 with declining earnings fails every quality screen. You'd want to see at least 2-3 quarters of stabilizing, growing revenue, margin improvement, market share gains, legal issues resolved. My 2 cents, not financial advice. Nike isn't a buy yet for me, but it's on the watch list. I want to see proof that the turnaround is working, actual results, not just strategy slides. At $50.55, maybe. At $68 with a 35 PE and falling earnings? I'm sitting this one out for now. For the risk takers, this could be your Michael Jordan, I took that personally, moment, a chance to buy a legend on the cheap. Just know you are betting on a comeback, and those are never guaranteed. Warning: important disclaimer warning. Alright, folks, here's the part where I legally have to tell you, this is not financial advice. I'm not a financial advisor, and you shouldn't make investment decisions based solely on some random person on YouTube, even if that person did a ton of research and made some killer jokes. Everything in this video is for educational and informational purposes only. The stock market is risky. You could lose money, lots of it. Past performance doesn't guarantee future results. Nike could soar, or it could tank further. Nobody knows. Before investing, please, do your own research, consult with a licensed financial advisor, only invest money you can afford to lose. Understand that all investing involves risk. I do not own Nike stock, and I have no financial relationship with Nike or any companies mentioned. Got it? Good. So there you have it, Nike, a swoosh that's lost its swagger, but maybe, just maybe, finding its footing again. What do you think? Is Nike a buy at these levels, or would you wait for more proof? Drop your thoughts in the comments below. I love a good debate, and some of you are way smarter than me. If you found this analysis helpful, smash that like button, subscribe for more deep dives into stocks and markets, and hit the notification bell so you don't miss the next one. Thanks for watching, and remember, do your own research, invest wisely, and never, ever put all your eggs in one swoosh branded basket. Until next time, just do due diligence.